You work hard and your money should work even harder for you. Any hardworking individual has this reasonable expectations from one's investment. Generally, investments are classified as passive investment and active investment. Passive style of investment is mostly about buy and hold, sit tight. One just expect market return expectations. So no major activity on investment portfolio. But if you see the examples of Dow Jones and Sensex, in last 10 years, 20 years, 30 years, they came from this level to this level. So huge inspiration for passive style of investor in terms of wealth creation. So simply buy and hold investment been encouraging for them. While active style of investments, it's all about buy and rotate with market beating expectations. They need continuous monitoring of the portfolio and strategic decision making, because if you see Dow Jones and Nasdaq in the same 10, 20, 30 years, it has seen multiple 20% market corrections and so many time corrections in a frequent basis. So key learnings for active style of investor is buy and hold, but also book interim profit and reinvest back. Both investment strategies have their merits and few demerits, but active management offers investor more control over their portfolio and the potential to outperform the market. In this video, we will see, can investors follow both strategy while compromising on without compromising on long-term investing and its wealth creation with the benefit of minimum risk and maximum return. In the end, I will share few steps how to become a successful active investor. So very important to watch the video till end. It's all about taking charge of your investment, evaluating their portfolio at different time frames like 3 months, 6 months, 1 year to 3 years to assess performance. But there is a big warning for investors. Active investment, it's not about looking at the portfolio on a daily, weekly, and even monthly basis. One must differentiate a trader mindset who often looks at the portfolio frequently versus an investor who only evaluate the portfolio every 3 months to 1 year. So the major goal in active style of management is to identify underperforming investments, and its action plan is to hold or exit the same underperforming investments, while also booking profit in outperforming investment with an asset allocation and rebalancing approach. When executed effectively, active management helps generate alpha, the extra return as compared to general market. Active management offers psychological comfort, because investor also panic in profit too, and by booking tactical profit, it provides investment satisfaction. So investors often feel anxious during market fluctuations, especially when their portfolios lose value. With active management, investors can book profit with value when valuations are high, ensuring they do not suffer heavy losses during market downturn. See, if an investment grows from 100 rupee to 120 rupees, booking profit is a wise decision. If the market later corrects and the investment drops to rupees 80, so reinvesting this 20 rupees as a profit at this point of time at a lower level not only give additional gains but secure those profit which been earned with a lot of patience and perseverance. Active management is risk and reward management of overall portfolio, following tactical asset allocation approach, giving equal importance to fixed income instruments like equity, gold, and real estates, with minimizing risk and optimizing returns, with constant vigilance on portfolio periodically. So active investing encourages investors to improve their market knowledge and analytical skills. It increases awareness of financial, economic, and global market trends, helping investors make informed decisions. Additionally, it also allows investors to benchmark their performance against market indices and peers, enabling better investment choices. So while active investment offers numerous benefits, it also comes with certain risk and challenges, such as active management requires continuous learning, monitoring, and the use of advanced tools for financial analysis. Expert consultancy is often needed to make sound investment decisions. Selecting the right investment advisor or fund manager is also extremely important, with evaluating cost versus the performance is essential to make the right investment choice. Say, for instance, if a fund manager delivers a 10% return with lower risk, they are more valuable than one who delivers the same return but with a higher risk. So identifying investment which fall less and rise more versus the overall market conditions. The one major drawback of active management is the tax impact of frequent buying and selling. Short-term capital gain tax attract higher taxes, while which can eat into the overall returns. Investor must carefully assess whether this strategic profit booking justify the tax burden. Provide the proper planning can help balance the benefits of active management with the tax implications. Booking 10% profit on the portfolio with potential downside of more than 10% and effective tax is less than 10%, then only it makes sense. For paying less tax and securing more profit and protecting portfolio with lesser downside. So in earlier times, passive investment was the dominant strategy due to limited access to market, lower liquidity, and fewer investment tools. Investors did not have sophisticated financial instruments or online platform for quick transaction. As a result, they relied on a simple buy and hold approach, helping investments for long period with minimal intervention. But over the time, the financial world has evolved significantly. Today, investors have access to this abundant market data, higher liquidity, and advanced AI-driven tool that enable more informed decision making. In developing countries like India, active investments tends to outperform passive strategies due to market inefficiencies. Emerging market provide a lot of growth and evolving economic policies. While in developed markets like US and Japan, passive investing is often more effective due to higher market maturity and their saturation. In ValueEthics, which is a Pune-based SEBI investment advisory firm, we follow our own proprietary equity maximizer software, which suggests whether to invest into an equity mutual fund or stock or overall wealth portfolio. Any top-up investment in this purple zone or in this lump sum investment in this yellow zone or simply staying invested in this green zone and booking tactical profit in the red zone. We basically have a 18 installment unique active SIP equity mutual fund model and comparing it with a typical 12-month passive SIP model where 6 extra installment in purple and yellow zone give an outperforming return versus a regular SIP by 3 to 5% annually. One can check our SIP and lump sum calculator for our credible track record and reach out to us through these contacts. Warren Buffett, despite being a long-term investor, employs active investment strategy when needed. Berkshire Hathaway liquidated his holding just now in S&P 500 ETF from Vanguard and State Street Global advisors to manage cash flow efficiently. So Buffett firms has set a net seller of securities in 9 consecutive quarters, increasing his cash reserves to $334 billion for the future opportunities. He has periodically reduced or exited certain stock position based on market conditions. So these actions demonstrate that even legendary investors like Warren Buffett use active strategies to optimize returns. Let's take these two examples of passive and active investments. This particular investor has invested 1 crore rupee, whose portfolio has appreciated by 20%. The portfolio has become 1 crore 20 lakhs. Now, with an objective of booking 20% profit, he has removed 20 lakh rupee and parked into a liquid mutual fund, and now he is just staying invested in this equity fund with 1 crore rupee. But now when the market falls down by 20%, this 1 crore becomes 80 lakhs. While here the 20 lakhs get protected. When the market goes down, the same 20 lakh rupees get reinvested in this 80 lakh rupees, and the portfolio from 1 crore rupee with a 20% gain goes to 1.2 crore. While if he don't do anything, then with this 20% market fall, this not only this 20 lakh rupees appreciation get eroded, but he don't have money actually at a lower level to reinvest it back. So these are the two stark examples where just passive investment and buy and hold approach is not good enough. You have to do some active management. So what are the key learnings to become an active investor? The thumb rules. As per my practical experience for last 20 years as a practicing AMFI registered mutual fund distributor and SEBI registered stockbroker, objective profit booking is the best rule. It means 15 to 20% return on the portfolio. One may book profit tactically. I mean rupees 100 become 120. Remove only rupees 20 and stay invested with the rupees 100 for the long term. If the market continues to move up, rupees 100 will keep on moving up. While if the market fall, at least rupees 20 earned with so much of hard work and patience stays intact in the portfolio, and at a lower level rupees 20 is available for the reinvestments. Analyzing the over and under exposure in your portfolio. Say portfolio has 5 equity funds. But with even Steven allocation, the percentage allocation of say a large cap fund is 10%, or for the small cap is 30%. So here small cap need to be brought down to equal allocation, and the large cap to be brought down to again to the equal allocation, so that in uncertain times risk and reward matches in the portfolio. Capital protection with fixed return is also equally very important. Portfolio must have market linked funds like stocks and equity funds, but also bond linked funds like debt funds, fixed deposits, liquid funds, to have a capital protection in place with stable growth. So balance of variable returns and fixed returns is the key. Minimal tax impact, like in India and major economies, long-term capital gain tax is 12 to 20%, and beyond 1 year investment holding period, while short-term capital gain tax of more than 20% in less than 1 year holding period. Here, while booking the profit, one must evaluate the tax impact versus the profit booking, its pros and cons. Profit must be much more than its tax impact. The most important is the mindset of a trader versus the investor. See, the trader means who is obsessed with the short-term volatility on the portfolio, while the investor is the long-term player with an eye on wealth creation, taking any short-term negative volatility as an opportunity to buy more into this long-term holding. So one must develop a character to differentiate oneself from the other. Self-education and professional help. So one must empower oneself with the learnings of financial market. Investment education is key to successful active investor, while associating with a seasoned investment advisor who has a technology tools, predictive analysis, and research for active portfolio management is equally important for outperforming wealth portfolio. Defined financial goals with the time horizon, the funds which you don't need in the long run, that should be invested into market linked funds like equity instruments and real estates, while the funds which you need in the short term should be invested into fixed return bonds and fixed deposits kind of instrument. So in conclusion, if you are a salaried person or a businessman or a person who is a very occupied and can't give too much of time to the research and to the management of the portfolio, we here at ValuEthics, a Pune based 18-year-old AMFI registered, SEBI registered firm, can help you manage your active fund management as against the passive fund management through our equity maximizer software. For more such details, you can contact to us. And at the end of the video, you can see the systematic withdrawal plan, how a 3-year, 5-year-old MF investor has nothing to do with a 10% market fall. Worth investing your time on this video, because time is money and we value your time. Happy investing.